Hello, my name is Tim Newell, Managing Director and one of the Senior Portfolio Managers here at Harvest Investment Services. Now, many of our AlphaSolutions models are rules-based tactical models that have proven out performance in both up markets and in down. Today, we're going to look at the AlphaSolutions 1350 strategy in order to better understand how we use rules-based models with downside risk controls to grow and protect your investment portfolio, which is actually very different than the typical buy and hold approach. The AlphaSolutions 1350 model utilizes and invests in the 5 major U.S. domestic indices, being the Dow Jones Industrial Average, the S&P 500, the Nasdaq 100, the MidCap 400, and the Russell 2000 Small Cap Index. Now, what's different about this model from the traditional buy and hold approach is that it uses a risk-on, risk-off approach when investing in these 5 major indices instead of the typical buy and hold approach that most have used. We do that by following their individual price trends. We use the trend of their moving average to make decisions about when we should be in a position and when we should be out. Basically, when any one of these 5 indices trends out, we sell that position and remain in cash until that position trends back in again. When the position trends back in, we will then repurchase it and remain in it until it trends back out. So specifically, to determine the trend, we track the 13 and the 50-day moving average. For instance, as you can see here on the S&P chart, when prices are increasing, the shorter-term 13-day moving average you see here in green will respond fairly quickly to the price changes and will cross above the slower 50-day moving average line that is shown here in red, thus giving us the buy signal for the position. Then when prices decline, the faster responding 13-day green line will cross below the 50-day red line, which provides us with the sell signal. You know, this is very similar to the rules of the road when you think about it. When you're driving along and you encounter a red light, what do? You stop. And when that light turns green, you go. A great example of the strength of the 13 50-day moving average crossover can be seen in looking at the last major market decline that we see from the fall of 2007 to the spring of 2009, when markets declined by over 55%. For the typical buy and hold investor, it took all the way till December of 2012 to recover those losses and just get back to even again. However, an investor using the 13 50-day moving average crossover approach gained an additional 40% return, while the other typical buy and hold investor was just trying to get back to even. Although this strategy has worked extremely well as a means of controlling downside risk of a major market decline, there are times it will have its challenges. We call those the yellow light periods. Now, a great example of one of those yellow light periods you can see here on the screen is the fall of 2016, just prior to the last presidential election. As you can see here on the screen, the faster 13-day moving average, depicted in green, actually crossed through the slower red line on or about September 20th. However, as you can also see on the screen, these lines somewhat hovered over each other and kind of crossed back and forth for several weeks. This is what we refer to as a yellow light period. In these times, we as the portfolio manager have to attempt to sort of get through the intersection safely as you would in driving through a yellow light. So we typically use a 1 to 3% trailing stop loss to better manage the downside risk in some of those yellow light periods. Stop losses, as they are referred to, can be a great way to limit your downside risk if the underlying position continues to fall in value. The goal is to keep from just selling out of a position and just having to come right back and buy it back again, and often at a slightly higher price. Now, sometimes that will happen, but we want to attempt to use trailing stops to keep those sells and fast buybacks down to an absolute minimum in those yellow light periods. To recap, the goal of investing in the AlphaSolutions 1350 model is to participate in the growth of the broad U.S. stock market when those markets are trended in, and to avoid the larger market declines when they're trended out. It should be reasonable to assume that if you can be in the market the majority of the time when markets are going up, And out of the market the majority of the time when markets are going down and in decline, that you should have much greater return results over multiple market cycles. Hopefully this helps you better understand our AlphaSolutions 1350 model strategy and how we use these rules-based models that all have downside risk controls built in order to help you achieve greater long-term results by avoiding the major market declines that buy and hold investors have often experienced. Here at Harvest, we call it harvesting gains and limiting losses. Now, for more information on this or any of our other AlphaSolutions models, you can view the fact sheets on our website or speak to the investment advisor representative that you're working with to determine how this or any of the other AlphaSolutions models might fit into your overall investment portfolio. Thank you.